Let's see if we get any clues from Australia. And I mentioned this because we've had a rate decision from the RBA. No change so far, so simple. But interesting that they're talking about inflation proving persistent, amping up the language there. The case for a rate cut was not even considered, and the market is concerned about rate hikes in the future in Australia. What do we learn from the Australian example?
Well, at the start of the year, Anna, the markets were thinking we would get 3 rate cuts from Australia. But 6 months into the year, what is transpiring is that forget a rate cut. They're thinking about a rate hike. And the governor, RBA governor, said as much in a press conference this morning. And if you look at the RBA statement, it's extremely hawkish. It says they reintroduce the language saying that they will do whatever it takes to contain inflation. That looks like that is very reminiscent of what the ECB has been saying of late. And it also ties into the big picture here, Anna, which is that of higher neutral rates that we are in. If you look at the Fed's neutral rate, last week, they raised the neutral rate estimate to 280. Just months ago, it was at 250. So 30 basis points we have done in the space of just 2 months. It's not every day that the Fed raises the neutral rate. So that says something about this expansion, the strength of this economic cycle. And investors should therefore be assuming that rates are going to be higher for longer, which is why I think that the market's pricing of 2 rate cuts from the Fed this year looks a bit overstated to me.
OK. And Ven, if we don't get those cuts, and there's different views out there as to how many we do get, if any, what does that do to stocks? Stocks have been so resilient as we've priced out rate cuts this year. Well,
stocks are in a case of heads I win, tails you lose kind of situation. No matter what the Fed has been doing with rates, stocks have been going up. And, that is obviously due to the enthusiasm surrounding artificial intelligence and the prospect of it to boost productivity. Now, I ran some numbers, and what it shows is that if you assume NASDAQ as a long duration bond, discount the future cash flows and bring it to today, it shows that the fair value is around 13,000. So we are vastly in a bubble at this moment.